Welcome, everyone. Today I'm joined by Lead Analyst Logan Mohtashami to talk about inventory, from the Airbnb bust that never materialized to the steady existing home sales numbers, and of course, about mortgage rates. First, here's a word from our sponsor. This is Sarah Wheeler, Editor-in-Chief at HousingWire, with Ryan Marshall, CEO and founder of Equity Protect, to talk about a very specific and growing kind of fraud risk. Ryan, who is really at risk of deed fraud?
So that's a great question. I think we should first state by saying that the people who are not at risk are people that just recently acquired their properties, people that have loans on their properties, often high loan amount, high loan to values on their properties. Those are people who I would consider as very low risk and people that should probably not consider our service as a service. So as of November of 2022, we've identified 83 million parcels across the nation, which is roughly 54% of the total parcels in the entire country who we've deemed as vulnerable. These parcels are specifically ones that don't have mortgages, parcels where they're non-owner occupied, properties where the mailing address isn't associated with the site address, and they're in some type of vacation area or vacation property area where lawful homeowners wouldn't necessarily know if an appraiser showed up or if somebody just drove by your property and did a quick appraisal on it.
Thanks, Ryan. Listeners, you can find out more information at equityprotect.com. Welcome back to the podcast, Logan.
It is wonderful to be here, Sarah.
It is wonderful to have you here. So we have lots of different topics. First one we wanted to talk about was what happened to the Airbnb bust, right? Like, I thought we were going to have millions of homes that people could buy, stimulate the real estate and mortgage industry. What happened?
The Airbnb bust itself. It's kind of like, the forbearance crash bros, forbearance itself collapsed. Here, the Airbnb bust was kind of almost a marketing gimmick to a degree. It's the Airbnb bust was actually a 2021 story, because what occurred is that nobody was traveling and all these people had these Airbnb bust homes and none of them could keep the property and that they would have to sell. That obviously didn't happen. I think this one is, we have to realize there's a group of people that are trying to make housing like massive investor boom. And this is going to explode in inventory just like it did during the housing bubble crash years. What a letdown. Sarah, it is almost Halloween in 2023, and we are like nowhere close to the 50-year average of active listings. And this is year 4 now. First it was COVID, then it was forbearance, then it was, mortgage rates, the big collapse in home sale. And, this year Airbnb bust was getting so much attention. And what I'm trying to always emphasize this year is that, oddly enough, the craziness of the housing market and the bond market and mortgage rates and everything that's going on in the world, the one data line that has been consistently calm was the new listings data. And we wrote about that in the tracker article, that I think one of the fears is that if mortgage rates keep on going higher, new listings data would take another leg lower, and we would start a brand new all-time low and work off of there. And it has just been remarkably steady. The only time that we saw any kind of volatility in his data was around Labor Day weekend and when school's starting. And a lot of that has to do with we're working with the lowest levels ever recorded in history. So any kind of holiday can really move the numbers. But outside of that, it's just been very steady Eddie. We haven't seen the major escalation in distressed inventory, and we haven't seen the other fear of, mortgage rates getting so high that people will stop listing. It's been a very, very steady a year so far.
Okay, so let's talk about the numbers of this, because this is what people always, I think, they get over their skis on this, because they're like, oh, there's millions of homes. And let's not forget, all of those homes that were bought up by investors after the great financial crisis was because the government was like, hey, we need some help. We have all these vacant homes. Can you take them over and like rent them out? Because it's not good for neighborhoods that they're sitting there. So that's why a lot of that happened.
Sarah, one of the things that was interesting, the Airbnb bust people are also second home bust people. So a great example I did on Twitter, which is hilarious. One of the crew said that there was 5 million second homes bought in 2020 to 2021. 5 million. And I sat there and I'm like, these people are crazy. So I just retweeted the person that said, well, let's think about this. There's like 6 to 6.5 million total home sales per year. So in 2020 to 2021, if 5 million homes are like, you're looking at 40% of all homes were bought were a second home. So then I thought, okay, how can we show this? And then what I did is I actually took the data from Optimum Blue, and they showed the rate locks for second mortgages or for second homes. And we're like trending at 4%, 4%. And then we got 5.5%. So you get this little blip, of course, a little blip of second homes. And then, of course, a lot of second homes were bought with cash, but that was it. How do you get 5 million people? How do you get 5 million homes bought in 2 years? That's like almost all the worth of homes right now. I mean, we're going to get like near 5 million total home sales this year. So I think the best way to explain the Airbnb bust scenario is that usually what happens with short-term rentals is that they become long-term rentals first. So the notion that the major escalation that was supposed to happen July, August, and September, and now we're almost in October, it hasn't occurred. So most likely, if there is somebody that's having a hard time renting out the short term, they move it to long-term rentals first. So that explains the very calmness of the new listings data. But also, I mean, realistically, let's keep this as real as possible. There's over 144 million total housing units in America. Airbnb bust, I don't even, excuse me, Airbnb, I don't believe even got to 1.2 million. Like it was trending like 900,000 and almost got to 1 point. So there is growth in this. The listings of Airbnb is the highest ever, but it's also not quite, the high velocity inventory. And then this also goes into another discussion that I try to teach this with the Airbnb bust people, that during the housing bubble years, the credit boom, a lot of investors had option arm loans. So they'll have 7 or 8 properties on option arm loans, and the option arm loans got really exotic in 2002, 3, 4, 5. It got really crazy in 2005. So the entire debt structure of loans back then facilitated a lot of what we call forced credit selling in that light, and then foreclosures. Here, boy, COVID, forbearance, 7% mortgage rates, the biggest home sale crash ever. Here we are, 8% rates. And the new listings data as of last week, Sarah Wheeler, was down week to week, mild, down year over year, mild, which makes it today the lowest new listings ever recorded in the history of America in the year that we were supposed to see the biggest bust ever recorded from a short-term rentals company ever. Ladies and gentlemen, boys and girls, women and children of all ages, we just added another one on year 12 of the Housing Bubble Boys 2.0 list of crazy things that have not occurred. And it's great that we're almost at Halloween because it just quite didn't get there.
Well, also, as you and I have noted in the past, many of the Airbnb listings are not for full houses. So even if somebody was like, oh, I gotta, the bust, it's like, what, they're gonna foreclose on the one room that they had? I mean, I know I look on Airbnb all the time. I travel a lot. I am a former Airbnb operator, and I can tell you there are tents, there are hammocks, there are couches, there are bedrooms. It's
Sarah,
crazy.
does this mean you're reading?
It would
You're
mean that,
reading,
yeah,
right?
I am, yeah.
What do we always say? We always say reading is a good thing. The history of human civilization has always taught us that those that read will always have an advantage over people that don't read. And one of the reasons why we do the nerd tour, one of the reasons why we always talk about showing the charts and the data is when people get perspective of actually reading something or just getting the visuals of the charts, really, a good chart, how it's explained, the chart should do the work itself. Then a lot of things get cleared up. So I understand why they do it. I get it. I mean, I've always said there's some people who always want to ice skate uphill. It's just who they are. It's the nature of the beast. And then we are the pilgrims in an unholy land. and disinformation and information in this regard it benefits what their goals are of trying to get attention, but really it is the irony of all ironies that the year that we've had now, it's 15 months now, by the way, because mid-July 2022 is when the new listings data took a noticeable dive, and it's literally been trending at the lowest levels ever recorded in history for 15 months. The time that we were supposed to see the biggest investor collapse and increase in inventory tied with the lowest new listings data, and there's nothing that's going to change. This is history. This is in the books. It's done, right? So this was another added to the major whiff. Right. So when we see distressed inventory data, we'll see it in the new listings data. We'll capture it first, not them. Okay. And when we could talk about it, especially when we see stress in any of the credit markets or even in the economy. But this wasn't it. It wasn't in 2021 and it wasn't in 2023. But I think this one is a little bit sweeter, like a nice, sweet Halloween candy. The year that was supposed to be the bust ended up being the year with the lowest new listings ever.
And you've been tracking this on the housing market tracker. You've been hoping to get some weeks that have had between 11,000 and 17,000, growth of new listings that way. And you haven't gotten it yet.
I am batting. Can you believe this? I'm batting zero. And with 8% mortgage rates, I'm just, and one of the reasons why we talk about this on the tracker article all year long. If mortgage rates start to rise, especially if they're going above 7, we should have at least a few weeks between 11 to 17,000 active inventory growth, right? The whole model is based on inventory growth,
Right.
slow demand, days on markets grow. And literally, I'm here thinking, okay, it's 8% now. I've got to be able to get it this week. And literally, the growth rate slowed, right? So the only way I could explain this is that it's October, right? So the seasonality of active listings is, there are people that, we usually see a decline. If this was March of 2024, we should be able to get it because of the seasonality factor is better there. But this time it just hasn't worked out. And last year when mortgage rates spiked, the peak of listings actually was October 28th. Now, of course, we're starting the seasonal bottom later these days. So you can make a case that because we start so late that we end a little bit later. But in this case, we should have been able to get at least a few weeks between 11 and 17,000 and whopping zero.
Whopping zero. It almost seems like there's a mortgage rate lockdown, and that's why higher rates have not resulted in more inventory. I think that's what you're saying, right?
Except the data has not confirmed that. The data has always confirmed that you actually get more inventory with higher rates. My weekly inventory data didn't get there, but we had 9,000, 7,000. We actually had faster growth with higher rates. It just didn't get to my level. And when we go back into the data, last year we saw inventory growth. The slope was faster with higher rates. 2018-19, we saw the slope a little bit faster in certain areas. We saw inventory growth happen there. 2013-14, we saw the same thing, right? The only way inventory grows in America that we've seen in the data now for 13 years is higher rates slow the market down and inventory grows that way, right? Lower rates, on the other hand, nothing. Don't have it in
We
the
will
data line.
see when we look back at the data from this period, we will see if
I
this
have
was an anomaly.
13, Sarah Wheeler, I have 13 years of data on myself. I wish I could have at least 1 year that I could actually incorporate this, because then I could add a new whole variable time. And that's a lot of fun for me. But the problem is you're asking me to say something that is never factually true,
Well, you know what?
right?
It hasn't
So,
been factually true in those 13 years, but it might be when we look back at this year. So we will have to
well,
see.
when it happens, then we could say it
We can talk
happened one
about it.
time,
Yes.
but you're asking me to tell our viewers that it's okay to lie and it's not okay to lie. We're
No.
going to go with the data, and the data does not show that active inventory growth. And listen, part of this is this, one of the things I realized this year about this whole debate that we're doing, by the way, people are asking for the video of the defeat of Sarah Wheeler at HousingWire Annual. When are we getting that up for people?
I will
I mean,
check,
the
but
public
so like
wants to watch,
I'm
and
not super
especially,
excited about getting that up, but I'm not in charge
yeah,
of
we
that,
should
so
get
I'm
that
not
up,
gonna
because
do it.
then it goes. And one of the things that's interesting that, again, it's partly my fault because I probably haven't talked about it enough. when we talk about why doesn't active inventory grow with low rates? Well, when you get your home in a contract, if you're closing it below 30 days, it doesn't fall into the active inventory. Your house is gone, right? So when demand picks up, what happens when lower rates happen? The first time home buyer picks up because they finance 90% of their mortgage. So whatever is coming onto the market, they're getting. We close transactions faster these days than what it used to be in the past. So part of it is just the procedural. We close loans so much faster than what it used to be. I remember, it used to take like 45 to 60 days to just do a loan sometimes. It took long. Now because of technology and productivity and everything, things close faster. So it doesn't allow the inventory to kind of hang on. And that explains some of the factor why inventory growth, those charts. Remember that chart that I draw that black line, Sarah? Whenever rates go lower, so here it's an interesting year because higher rates recently has created a little bit more faster growth on the inventory side, and we're actually almost getting to flat year over year. We've been negative, as mortgage rates went lower last year. Toward the end of the year, demand picked up, inventory went lower. We had the latest start ever for the seasonal thing. But with higher rates, you see that growth rate. So the question is, do we actually have 1 or 2 weeks that are positive year over year? In any case, we're still at near the bottom. And this is the situation with the inventory. That's why the weekly tracker was created, so everyone could have live data up to the week, and then everyone gets to see if there is an Airbnb bust. Boy, the new listings data would go vertical. I keep on saying this. We will never be able to miss this now, right? Don't be the ones that don't be the person that says, I don't know. Why? We're going to see it in the data. And because we're working from the lowest levels ever recorded history, man, that spike is going to be vicious because it's been so slow and steady this year, especially now with 2023 ending the year with the lowest levels ever recorded in history.
So let's talk about mortgage rates. Okay. So I know that the bond market has been so crazy. Have you gotten any sleep in the last week at all? Because so much happens overnight. And you are updating our audience on our mortgage rate center. You do an update every morning. You're like, here's what you should expect today. And then you do a video for our audience. Are you getting any sleep, Logan?
It's the overnight trading, which a lot of people might not be accustomed to, has been pretty wild lately. And of course, a lot of people who listen to this podcast, a lot of them follow me on Instagram, and I do these Instagram stories, and I show the bond market like at 11:30 at night, and go, "Oh, we finally have a calm trading day." Like, "Oh, here we go again." And that's probably, a lot of people aren't versed to overnight trading or what's happening overseas, but we've been so wild lately. And just, when we saw that the 10-year yield get over 5% that day, and then just have a really huge reversal, some of the Wall Street for Bill Gross, they covered their short the bond market, and now they're saying, oh, it looks like the economy is slowing down, so you want to go long bonds. We've talked about the itchy fingers, right? The wild moves that you see day to day. Now, this is being recorded on Tuesday. So who knows? By the time Thursday comes, we don't know where the 10 yield is, but it looks like the 10-year yield, as a short-term peak. And then we just need this to slowly move lower and not have the Fed. Somebody tape the Fed's mouth, right? For the rest of the year, just tape it up. You don't need to talk anymore. Please, no more hawkish statements for the sake of mankind. Let it go, right? It's almost Christmas, Thanksgiving. Just, let the bond market kind of take things slower. And it's just been wild the last few days. And that overnight tradings really is. And what we do in the morning is that we give everybody an update on what's happening. If there's any economic news, we see how the bond market reacts to that. But as I'm talking right now, it's 4.80. So we're not over 5, but we're slowly trending lower after that big reversal in that day.
So we're hoping, you said last week that you could see that some of the activity in the bond market, it seems like we could be heading for a top. And then do you think that happened like Sunday night or Monday
Yeah,
morning?
it's literally it was last year at this time. Last year, October 27th is when I wrote that article saying, okay, the case for lower mortgage rates. just a short-term top at 4.25 just because the dollar was getting stronger. We had a lot of market stress. Now, last year, the bond market was sniffing economic weakness, right? Because on October 27th, the main Fed's recessionary indicator went off. So bond traders, okay, they're going with that. Okay, and the next move should be lower. Now, we got all the way down to like that 3.37 level. And I was like, start of the year, I got to bring Gandalf. I got to bring Gandalf until the labor market breaks. I don't think we're going to go below this. So we got to those levels, and the Gandalf line held all 8 times except once. One time they broke. That was the peak of the banking crisis. So the bond market was pricing in a recession or the Fed cutting, and then the banking crisis has kind of gone away. We haven't heard much stories then. Jobless claims have reversed. We were in an uptrend on claims. That actually reversed. We actually got below 200,000. So the bond market doesn't have the same backdrop, but real yields are so restrictive right now. So if you're going to make a case that 5%, 504%, whatever the top there, it's that the history of real yields being this restrictive means that the next 12 months, the economic growth is going to slow down. And what the one sector that gets hit the hardest is housing, which is, by the time this podcast comes out, the new home sales report is out on Wednesday. And one of the ironies of this cycle is that the builders have been able to move product because they're buying down rates. I think Pulte Homes had whatever, like 80% plus of their buyers get buy down rates, and they have the profit margins to do this. It costs $20,000 or $30,000 for them, but that's how they move their product. So in a sense, the Fed wanted to create higher labor supply. Well, the builders would be firing their construction workers because they wouldn't be constructing home if sales go down. But since their profit margins are so high, they're paying down rates, they're moving products, and that's one of the main reasons why new home sales is still growing year over year. And of course, when lower rates went lower toward the end of last year, the builders' confidence started to increase, and home sales in general went up. But in this higher rate environment, they're still pushing that lever for the buy downs, and it's helping them move their products. So really interesting, different cycle, different variables here. But I probably in the back of the mind of the Fed, they're like, man, we just wanted a recession. Why can't these construction workers be fired to make our jobs easier? So good for the builders because they're keeping people employed and they're moving sales, and that's good in that regard. But that's the interesting dynamic. And they can do this because their profit margins are higher in the last few years than it was pre-pandemic.
I continue to go to builders around in my area in DFW. I went to a different one on Sunday, and they're giving $40,000 off. And I'm not looking at really expensive places, so I thought that was really interesting. I mean, they have the ability to compete in this market.
And when you look at the builders, when rates were heading towards 6%, if they needed to do a buy down, it cost them a lot less, right? So you could understand when rates were falling, the builders' confidence index started to rise, which people were like, okay, we're going into a recession. The HMI data never increases during a recession, right? It only increases through a recovery. So a lot of stock traders were kind of caught off guard with that. It's because they were paying down rates and whatever they need to do, cutting prices, they move product. Here, as rates keep on going higher, it's just going to cost them more and more and more because, again, they sell homes as a commodity, right? They're efficient sellers. They don't want to keep a backlog of units closed. So by the time this podcast comes out, we'll see how many homes are completed for sale. I think the number for last month was 76,000. Now I always go around the country and say, does anybody know how many new homes are finished and available for sale? Nobody knows that. 76,000 for a country of 335 million and 157 million people working. We have 76,000 homes. Go at it.
Well,
So they
a couple of times when you've
they
said that,
operate differently.
yes, and I've been with you. Somebody in the audience knows, but that's because they read you or they listen to us, and they're like,
Yeah.
that's the only reason they know
There's
that.
always yeah.
There's always somebody.
But it's just a very unique cycle. I think about this period of time because all my work was ready for years 2020 to 2024. Right here it is, and COVID happened and then everything changed, and we wrote the COVID-19 recovery model, and we had to do all these different things. And the irony is that everything that I thought that could go wrong, possibly actually kind of did. So it's kind of weird because people don't say they don't believe housing's crashing because prices aren't falling and people aren't losing their homes. But you see this really historic dive in sales, and again, those that followed us, late 2020, early 2021, were like, everyone, hello, prices are about to explode. Nobody knows how low inventory is, and housing inflation, when you have normal credit channels, can be a wicked thing, and that's what we saw. It's unfortunate. You would like to have a more balanced marketplace. I've always said, as long as home prices just grew 23% for 5 years, that's 4.6% nominal on a real basis, that's perfectly fine. That didn't happen. Literally by the summer of 2021, I already lost my price growth model. So it's just, you got to go with the hand that you're dealt with, and things, obviously the pandemic changed everything. So that's what we got to deal with. So we just wait for the next crazy thing to happen and take it from there.
Okay, so what are you looking for when it comes to the tracker next week?
Of course, number one, see if I could get one hit this year. See if the inventory growth could be between 11 to 17,000. So crossing fingers. And then, of course, seeing, we saw the first week of 8% rates. Let's just hope that new listings data just has a seasonal normal decline and not have another leg lower. So those are the things I'm tracking. And then, of course, we're toward the end of October, and seasonality kicks in. And then, if that happens, that's the traditional inventory cycle. There's nothing abnormal about it. So those are the only things I'm focusing on. But of course, the main story this year, really since the mid-July, is that new listings data has been trending at the lowest levels ever. And, in a time where people are talking about escalating inventory, it just hasn't been the case. You have to list your house to sell it, right? You just can't. Doesn't work that way, right? You can't sell your haunted house on Instagram in 3 seconds. But those, again, it's a little bit different now because we're toward the end of the year, and really, it's going to be very interesting spring 2024. I mean, especially if rates stay this high. I think that's the gearing up. That are we going to have a normal inventory channel year for the first time post COVID?
Rates cannot stay this high. This is not good. We cannot have 8% rates in spring 2024. I'm just lodging my complaint now to whatever powers it be. That is not acceptable.
Yeah. Well, if everything goes with economic cycles, that shouldn't be the case next year.
Oh, man, that's good to know. Logan, thank you so much for being on, getting us caught up. And we will talk to you again in a few days.
Pleasure. And trust me, everyone, we're going to get the video out between Sarah and I debating on the mortgage rate lockdown. And it was a thing of beauty. I cannot wait.
I can't wait either, because I actually think I made some great arguments. I did not win that room, but I could win overall. I'm still hopeful.
Sarah, I believe that you believe that you're going to win the argument always. You don't have to
patronizing. That is patronizing. Okay, we will all see, and maybe our larger audience will vote. How about that? That's what we'll do. All right.
You can have them all vote for you once, Sarah.
All right. Thanks, Logan.